So we're still dealing with this question for Mulenga company. Okay, we made the trial balance at first. All right, after we made the trial balance, we made our first part of the income statement, which is the trading account. We got our gross profit of 70,000. Now we're going to the statement of profit or loss. All right, yes. So after you've got your gross profit, next thing you need to add any forms of income to the gross profit. All right, so in this question here, the forms of income that we had was discount received. Okay, we're going to add it to the gross profit. As I said earlier on, this same discount received, if you want, you can deduct it here in these purchases adjustments here. Right, you deduct it in these adjustments, then it means you won't add it as income afterwards. But if you don't adjust it with purchases, you can add it to the gross profit as income. Okay, so we add 70,000 plus 400, we get 70,400 as our adjusted gross profit. There is no any other form of income in this question. So now, after you've done with the income, the next thing you need to do is now you need to bring in your expenses. All right, so now since this is dealing with companies, so we have to first start with our operational expenses so that we get our profit before interest and tax. Then we're going to deduct any interest, then we deduct tax. Okay, so from our trial balance here, we can get our expenses. We've got discount allowed here, we've got carriage outwards here, we have debenture interest. Oh, this will come later. We've got admin expenses here. Okay, we're just getting the operational expenses. We've got salaries here. And remember, we also have additional information too. Okay, because as I said, this additional information in the question, where is this? Yes, this additional information, usually it's done when you reach the statement of profit or loss. Okay, they've told us here we've got director salaries not yet paid. This is an accrued expense. Okay, an expense, when you incur it and you don't pay for it, that's an accrued expense, so we record it. Okay, so this director salaries is going to appear as an expense in the statement of profit or loss, and it's going to appear as a current liability in the balance sheet. Okay, any accrued expenses, colleagues, you will still deduct them in the statement of profit or loss even though they haven't been paid out, and you add them as current liabilities in the balance sheet. Okay, so this director salaries, we're also going to include it in our operational expenses. All right, the other expense, corporation tax, will come later. This ordinary dividend, we'll see it in statement of equity changes, this proposed ordinary dividend. Depreciation here, depreciation expense 9,200, we'll also include it. We have an accrued audit fee of 2,000, meaning this audit fee, we haven't paid it, it's an accrued expense, so we're also going to deduct it in the statement of profit or loss, and in the balance sheet it's going to appear as a current liability. Okay, colleagues, any accruals, any accrued expenses, okay, you deduct them in the statement of profit or loss. Okay, and you include them as current liabilities. Okay. Other times you might find accrued expenses for expenses which are already in the trial balance. Okay. So for example, we found an accrual for maybe administrative expenses, we would have added that accrual to the admin expenses. Okay. Even these director salaries, actually, we can also add it to the total salaries here if we want. Okay.
Sorry, I want to find out what do accruals mean?
These are expenses that you haven't paid for, which will be building up. Okay. Let's say, for example, a water bill falls due this month, you don't pay it. Next month it falls due again, you don't pay it. It means that expense will be building up, right? As time passes, you incur it and you don't pay for it, it's going to build up. Okay. Yes. So accruals, as I was saying earlier on, if you find the expense is already in the trial balance and you find an accrual, add it to that expense, huh? Okay. Okay. Yes. So those expenses, we now put them here in our statement of profit or loss, right? We have discount allowed, carriage outwards, accrued director salaries, accrued audit fee, depreciation bills, salaries, and administrative expenses. All right, we have all these expenses, so we total them up. Okay, 800 plus 4,600 plus 10,000 plus 2,000 plus 9,200 plus 8,000 plus 8,000. We get 39,600. These are the operational expenses. Okay. So the first profit we need to get is the operational profit, which is the profit before interest and tax. So you're going to see your gross profit 70,400 minus the total operational expenses. You get 30,800 as your profit before interest or tax, which is your operational profit. Any questions before we go to the next part? Yes. Can you speak clearly? I can't hear what you said. Could you say it again?
I'm saying that gross profit of 20,400, that was calculated after taking discount.
Yes, from the trading account. Then we added that discount received. That's how I got 70,400. Has that answered your question, madam? It came from here. In our trading account, we got a gross profit of 70,000. And we added income of this discount received. We got 70,400. So after I get your operational profit, we need to get our profit before tax. So to get our profit before tax, we just need to deduct our interest expense. Okay. You told us the debenture interest paid 10,000. All right. So our profit before tax will say 30,800 minus 10,000. 30,800 minus 10,000, you get 20,800. This is your profit before tax. This is the profit you start with in the cash flow statement. All right. Then after you get your profit before tax, we now need to get our profit after tax. So we're going to say deduct corporation tax of 10,000. 20,800 minus 10,000, we get 10,800 as our profit after tax. Any questions?
The third thing I would like to find out, there on the top part, after we post opening stock or inventory, then we do mind less sales returns. Are there portions where there are some other things that would require to be put there?
No. You're talking about this part of, you're talking about here in the trading account, right?
Yes.
Yes. This is the most they'll ask you to do. Okay. Sales returns, carriage inwards, return outwards. Yeah, basically those are the things you've seen. Yeah. Okay. So after you're done with your statement of profit and loss and you've got your profit after tax, next you make your statement of equity changes. Basically, you're just trying to make any adjustments that have been happening in the equity accounts. Okay. Any adjustments that have been happening in the accounts under the equity section. Okay. So remember, in the equity section, we were told, they gave us our ordinary share capital. That is one part of the equity section. This is the money that is raised from selling ordinary shares. Okay, colleagues, ordinary share capital, this is the amount that is raised from selling ordinary shares. Preference share capital, this is the amount that has been raised from selling preference shares. Okay. These amounts were given to us in the trial balance. Ordinary share capital, 120,000. Preference share capital, 40,000. Retained earnings, this is the profit that the company keeps. Okay, 16,000. Plant replacement reserve, we've brought in this new section here because in the question it told us 2,000. Creation of plant replacement reserve of 2,000. So basically that 2,000, in case any of our plant needs to be replaced, we'll find the money in this plant replacement reserve. Okay. If any plant needs to be replaced or it needs repairs, the money is being kept in this reserve. Okay. So whenever you hear any reserve, colleagues, just know it's just money the company has set aside for something. Okay, so plant replacement reserve, money that has been set aside for replacing plant. Okay. Then you have your total equity, where we added 120 plus 40 plus 16. Okay, we got 176,000. Okay, so these are all the accounts you find in the equity section, and there will be some adjustments that need to be done with them. Okay, so the first adjustment is the net profit of the year. Okay, the net profit of the year, you need to add it to retained earnings, because as I said, retained earnings, this is the money, the profit you keep. Okay. So earlier on, we were told retained earnings was, the balance was 16,000. Now after we made profit for that year, we brought in a 10,800. Okay, 10,800. The next adjustment that has to be made is the preference dividends that have been paid. Right, in the trial balance, okay, they told us the preference dividend that has been paid is 2,000. This 2,000 kwacha has been paid to preference dividend shareholders. So it means this 2,000 kwacha is coming out from the retained earnings amount, the money to pay the preference shareholders. It's coming out from the retained earnings account. Okay, that's why you have seen a minus here, minus 2,000, because from our retained earnings account, we removed the 2,000 to pay our preference shareholders. Okay.
Sorry, this statement of inquiry changes. Is this the fixed format of how it is?
Yes. This is a fixed format. You have your accounts on this top row here. Then the adjustments will be in this column here. Okay. So for preference, so preference dividends that has been paid is removed from retained earnings. Please do not remove it from the preference share capital. Okay. Even if it's, let's say, ordinary dividends paid, don't remove from ordinary share capital. No. Most of these you find they're affecting the retained earnings. Ordinary share capital and preference share capital, this is when like shares have been issued. Okay, if they've been issued, then you'll see you'll be dealing with these sections. But majority of the time you'll be dealing with retained earnings. Okay, because this is the money that has been kept as profit, and then now it's the one that's going to be used. Then we have this proposed ordinary dividend. Okay, they told us that the company is proposing to pay, where was this information here? Okay, proposed ordinary dividend of 25 kwacha per share. I think it was 25 and well. Okay, because let's see where it was here. Yes, the dividends are in ways. You can't jump from 15 ngwe to 25. There was a typo error. That would be 25 ngwe per share. So you have to calculate how much is going to be paid as these ordinary dividends. Okay, and this is how you do it. First, calculate the number of shares that these ordinary shares that this company has. To get the number of shares, it's just the total ordinary share capital divided by the value per share. Alright, so they told us our ordinary share capital is 120,000 kwacha. Alright, the value per share is 50 ngwe per share. So 120,000 divided by 50 ngwe, you get 240,000 shares. Okay, this company has 240,000 ordinary shares. Okay, Then the proposed dividend of 25 ngwe per share. So each share is getting 25 ngwe. So we multiply 240,000 multiplied by 25 ngwe per share. That is 60,000. Okay, that is 60,000 kwacha. That is being proposed to be paid to the ordinary shareholders. Now it hasn't yet been paid, it's just been proposed. Okay, so this proposal is going to affect the statement of equity changes. Here's the journal entry. You debit the retained earnings account, because this 60,000 which is going to be paid to the ordinary shareholders is coming out from the retained earnings account. Okay, now since it hasn't been paid, so that's why we credit proposed dividend as a liability. It hasn't been paid, it's just been proposed, so we'll treat it now as a liability. Okay, so this 60,000 which we're proposing to pay the shareholders, it's coming from our retained earnings account here. As I've said, minus 60,000 here. Okay, we're taking it out from the retained earnings account. Okay, any questions? Then remember they told us that we have to create a plant reserve. 2,000 has been set aside for a plant reserve, so that 2,000 is also being removed from the retained earnings. That's why we're saying minus 2,000. All these in the negatives, they're just saying this is coming out from this thing, from this account. Okay, so this 2,000 comes out from retained earnings and goes into plant reserve. That's why it's negative. Then here it is positive, because it's moving from one equity account to another equity account. Okay, so that's why we put it as a negative here, because it's coming out from retained earnings. We put it as a positive here because it's going to the plant replacement reserve. Then what you just do next is you just add everything up. Ordinary share capital, there is nothing, so it still remains 120,000. Preference share capital, there is nothing, it still remains 40,000. Retained earnings, it's 16,000 plus 10,800 plus negative 2,000, which just represents minus 2,000, minus 60,000, minus 2,000, you get negative 37,200. It means this proposed dividend should be revoked because there's not enough money to pay it out, so it should be revoked. So you have negative 37,200. Plant reserve, you had 0, now a 2,000 has come in, 0 plus 2,000, 2,000 kwacha here. Okay, so our total equity, you say 120,000 plus 40,000 plus negative 37,200. Plus and minus means minus, so just minus 37,200 plus 2,000. You're going to get 124,800. Okay. So in the balance sheet, under the equity section, ordinary share capital will have 120,000. Preference share capital will have 40,000. Retained earnings, negative 37,200. Plant replacement reserve, 2,000. And another thing, if you also add here horizontally like this, 176 plus 10,8 plus negative 2,000 plus negative 60,000, you still arrive to this number here. Okay. So this statement of equity changes, you are just doing the adjustment to the accounts under the equity section. Okay. Yes. Any questions before we now move to the balance sheet, statement of financial position? Okay, so once you're done with the statement of equity changes, the next is now the balance sheet. Okay.
Perhaps next time we can also do another question on statement of equity changes.
There is a question lined up after this. There is a question lined up after this, so that you grasp everything. So do not worry, sir. So colleagues, the balance sheet, this is the format. Okay, assets, total assets must equal liabilities plus equity. Okay, your total assets should equal the total liabilities plus equity. All right, so the first section is you start with your non-current assets. Okay, you start with non-current assets. Okay, you have this section, the cost, the accumulated depreciation, and the net book value. All right. So the cost for the non-current under non-current assets, we have land and buildings. Okay, so cost 460,000. Accumulated depreciation, remember in our trial balance, let me just take it here. On our trial balance, where was it? Provision for depreciation were given 200,000 for buildings, and they told us there's a depreciation expense of 9,200. Okay, so each year whenever you get a depreciation expense, you're always going to add it to the accumulated depreciation. Okay, colleagues, so that depreciation expense of 9,200,
Come again. What did you say?
you add your depreciation expense for that year to the accumulated depreciation.
For the previous year?
No, for that year.
For the year given?
If you say depreciation expense and you see accumulated depreciation, just know in the balance sheet you need to add it. Okay.
And what if it says just depreciation or provision or something like that?
They have to tell you what it's for, because they can't expect you to guess what it's for. It will be unfair for you to make you guess where it's going, so they will state to you. So the net book value is the cost of the asset. Hey, what's happening? Cost minus accumulated depreciation. Okay, cost minus accumulated depreciation. So we're going to say 460,000 minus 209,200. So say 460,000 minus 209,200, you get 250,800. Okay, so this is the net book value of the land and buildings. Okay, yes, the net book value for land and buildings. So since that's our only current asset, non-current asset, so that's where it ends for non-current assets. It's only for non-current assets that you're going to do this. Okay, cost minus accumulated depreciation, you get the net book value. That is how much this non-current asset is worth this year. Okay, that's how much it is worth this year. Any questions before we go to current assets? Okay, then you go to your current assets. Okay, you have to list them in order of permanence. Okay, the most permanent non-current asset. Oh, let me just get bundles. Sorry, was kicked out by network. Yes, so I was saying the non-current assets, you can list them from the most permanent to the least permanent, or vice versa, least permanent to the most permanent. Okay, so the most permanent the most permanent current asset is closing inventory. Okay, they told us in the question, in additional information, closing inventory 30,000, followed by debtors. They told us in the question 20,000, followed by cash. They told us in the question 10,000. Okay, so you total up your current assets, 30,000 plus 20,000 plus 10,000, you get 60,000.
What is the net book value? What does the net book value mean?
It's the worth of the non-current asset that year. That's how much the non-current asset is worth that year. So once you get your total current assets, you add them to also your total non-current assets. So 250,800 plus 60,000, get 310,800 kwacha. Those are your total assets. Any questions before we move to our equity section? under the equity section, you just follow the way we put it in the statement of equity changes. Okay, those balances we calculated: ordinary share capital 120, preference share capital 40, retained earnings negative 37,200, plant replacement reserve 2,000. So total equity 124,800. If you remember, this value we got it in our statement of equity changes here, 124,800. Okay, so if you want to even make life easy, you don't need to list all of these out. You can just put equity, the total 124,800. But I would advise to put the how I put it there. Okay, just that if they say you've got 10 minutes remaining in the exam, then you just say okay, here let me just put total equity. Any questions?
Mr. Mora, is it possible in the exam to start, let's say, for example, you start writing the balance sheet, you have not done the trading profit and loss, you just write the balance sheet, like, and then you go to trading profit and loss.
So what? You'll be wrong, because especially this section here for equity, because this, remember, this retained profit comes from the statement of profit or loss, so it won't balance. Okay, you have to follow the order. You can't start the statement of profit or loss jumping the trading account, or you can't start the balance sheet jumping statement of profit or loss and trading account. Neither can you also start the cash flow statement jumping these income statement as balance sheet. Yes. So next we come to our non-current liabilities. All right, the long-term liabilities. We have the 10% debentures, which were told are 100,000. Okay, so since that's the only non-current liability, that's why I've brought it to the total section. Okay, if we wanted, we could put it here and total it up with the current liabilities, but even like this is okay. Okay. After that, you go to your current liabilities. Okay, what has to be paid within that year? We have creditors from our trial balance, 4,000. We had the accrued auditors' fees and the accrued director salaries. Remember those two? Here, where were they? Yes, the accrued salaries of 10,000 and the accrued audit fee of 2,000. As I said, they're also going to appear in the balance sheet as current liabilities. Okay, because they need to be paid. Okay, even this corporation tax here, since it's been put here in additional information, corporation tax for the year 10,000. Okay, it's not in our trial balance, meaning it hasn't been paid. Okay, they have just told you corporation tax for the year, so also this will appear as a current liability because it hasn't been paid. They would have told us in there tax paid 10,000. So also the corporation tax is also going to be found under the current liabilities. Okay, so our accruals, 10,000 plus 2,000, 12,000. Okay, even this tax should be part of an accrual because hasn't also been paid. Okay, 10,000. All right. Then we have that proposed ordinary share dividend. That's 60,000. Also it, we place it here. So when you add 4,000 plus 12,000 plus 10,000 plus 60,000, you get 86,000. Then you total up 124,800 plus 100,000. 124,800 plus 100,000 plus 86,000. Get your calculator to confirm. We get 310,800. Okay. So the total assets is equal to the total liabilities plus equity.